Okay, well, welcome everybody. We're going to go ahead and get started. Thank you so much for joining us for our seminar this evening on reverse 1031 exchanges and bridge loans. My name is Jean Joe, and I'm the broker and owner of Perisson Real Estate. Just a little introduction, the name Perisson comes from the Greek word for abundance and overflow. And our company's vision is to serve our clients, our colleagues, and our community so everyone may thrive and experience abundance in their real estate lives. We were established in 2016, and we've been doing these seminars ever since. Used to be in person, and hopefully someday will be again. But we converted to doing these online seminars because of the pandemic last year. And we really want to, these seminars are really an outflow of our principle, our founding principle, which is abundance, that we do live lives of abundance and we can share with one another. To that end, we do really, we've been inviting other real estate agents from other officers, loan agents, just it's really, this is not a sales pitch, it's really because we want to be able to share and help educate people about the different topics in real estate. So for this evening, we're going to be doing, just as a quick outline, I'll be doing a very short real estate market update and then an introduction into our topic and why we're doing this. Then Ron.Ricard, who is the Vice President of IPX 1031, will be covering reverse 1031 exchanges, and Elsie Wu, who is our broker of, who is the broker of Abundance 99, will be talking about bridge loans, and then I'll have a few announcements and then we'll be done. As a disclaimer, this seminar is intended to provide general information only and is not to be construed as personal advice for your specific situation. And we highly recommend that you do, before you make any decisions, that you refer to your attorney and/or your tax professional. As to questions, we're asking that all participants stay muted pretty much throughout. If you have questions, you can type them into the chat and we'll try to address your questions as much as possible. We actually don't have a huge group, so if we have time for questions, we'll go ahead and just, you can also unmute yourself. We'll ask you to go ahead and do that. If we're unable to answer your questions, we'll follow up with you after the seminar, and please be sure to keep questions on a general level, as we will not have time to address all the specific cases and questions. And we really want to make this something that will be useful for all of the attendees. So again, we'll start off with a real estate market update and introduction. And this is a little slide I've been using for the past year. As we started out 2020, our home prices were starting to rise, as is common for our spring market. And then of course, last March, we had the coronavirus, the COVID-19 pandemic hit. And the question mark has been, what is the real estate market going to do? This next slide here shows the median sale price of single family homes in San Mateo County ever since 2007. And as you can tell, as you can see here, there's a trend line here where this dip is the recession that happened, and then it's been going up and down with fits and starts, but on a gradual increase. And this last block here is starting from January 2020 and then all the way through May. And as you can see, although it seemed like, for a couple weeks, for almost a month, it seemed a little bit scary because we weren't sure what was going to happen with the lockdown and, how far the pandemic would spread. We actually ended up last year in August, we hit an all-time high of 1.732 million. That's this little peak here. And then in February of this year, we hit another peak, 1.75 million. And last month, over 1.9 million. So that's up here. And just to let that sink in, the median sale price, as you all probably know, is when you take the number, the sales, how many houses sold below that price is equal to the how many homes that sold above that price. And it's pretty incredible because if you go back to even 2014, 2015, we were right about 1 million. And then just 7 years later, we're actually almost double of that. And looking at June numbers, although we haven't finished yet, I was talking about it this morning at our meeting, and we're looking to maybe top 2 million as the median sale price as of June. Looking at months of inventory, this is a little bit of the story of why the prices are where they're at. And months of inventory basically takes the number of homes that are on the market and calculates out, at the rate at which they're selling, how many months would it take for us to sell all the homes that are on the market. And generally, a 6-month level would be considered a balanced market. Above that would be a buyer's market. And then below the 6 months would be a seller's market. And as you can see, we've literally since 2012 been solidly at 2 months or below and just bouncing up and down. We did have in the fall, right here, you see that little spike. That is our March and April, because we did have a little bit of a spike of inventory because things were not moving so much. And even then, that was only about 3 months of inventory. Since then, it's just gradually come down and down. And so we've had our holiday, which went a little bit up again. And then over the last few months, it's been solidly about a month or less. So for May, it was at 0.9 months of inventory. And again, very, very low levels. And this is another way of looking at this data is the median days to sell for the same single family homes in San Mateo County. And you can see here that pretty much we've seen this lower marker here is 10 days to sell. And we did see a drop here, and that's only because the MLS stopped counting. And when we hit March and April of last year, they stopped counting for a little bit because the thought was it's kind of an extraordinary circumstance. So we're going to just pause for a bit. But we actually started seeing definitely the days to sell have been hovering around 10 days. And recently it's 8 and 9 days. So all in the single digits. And this is not just in San Mateo County. We're seeing that throughout the Bay Area and many parts of California. And as you see in the next slide, we're actually taking this nationally. And what we're seeing is that this is a 4-quarter price appreciation by state. And you can see that the scale here goes from 4.7% to 23.7% appreciation in 1 year. You can tell by the darker states. So that 23.7% appreciation is Idaho. So they experienced over 1 year, almost a quarter, almost 25% in terms of appreciation. And California here, we're also not too bad at 14.3% appreciation over the year. And that's throughout California. And so we're seeing this low levels of inventory, competitive offers, multiple offers, bidding way over asking. All of that is happening not just in our area, but throughout the country. And I've been hearing from agents in other parts of the country who they're not used to this and they're really getting overwhelmed and they don't like this kind of a market. This is something that we've been going through for years now, but it's something that is very new to other areas. And also I've been hearing that this is true even in other countries, not just in the US. Which leads us to one of our question that I wanted to cover is why reverse exchanges and bridge loans? So there are a few different things that I'll go over, topics that I'll go over. One is possible changes in tax laws, which are causing property owners to rethink their investment portfolios. There's also Proposition 19, which was passed in California last November. And there are some impacts to that, both good and bad, which are possibly causing more people to consider selling or exchanging their property. There are also rental restrictions in California that have been growing, and then also personal and financial goals. So just to dig a little deeper into those areas, so possible tax changes ahead. There is right now, there are proposals for changes in the capital gains tax. For instance, there is a proposal to raise the highest bracket from 23.8% to 43.4% for those with incomes over $1 million. And that, if you combine it with the California state tax, would lead to 56.7%. And as I had mentioned at the beginning, near the beginning, with median sale prices at close to $2 million, if you sell one property, you're most likely going to exceed that $1 million. There are also some proposed changes to the 1031 exchanges, such as a proposal to limit this exchange deferral to a maximum of $500,000 for a single person or single taxpayer, or $1 million for a married taxpayer. And again, that $1 million is pretty easy to hit in our area. There is also some proposal to change the estate tax exemption. So to currently it's at $11.7 million. There is a proposal to reduce that down to $3.5 million per person, or $7 million for a married couple, while increasing that top rate to 45% tax. And then finally, there's also a proposal regarding the step-up basis. Currently, and I'll jump to the second paragraph, second sentence, when an asset is passed on to heirs, then what happens is that the basis of that asset value is actually stepped up to the value as of the date of the owner's death. There is some talk about possibly eliminating that for any gains exceeding $1 million. And so currently, I do know of a lot of people who are holding on to their property and thinking, we'll just save it for my heirs, I'll pass it on to them, and then they'll get that step up in basis and really have a minimal capital gains tax that they're dealing with. And if that changes, that could cause people to have to rethink their plans. Also, already in effect in California, as I mentioned, there is Proposition 19. The good aspect of that is that eligible homeowners, so 55 years and older, and some other eligible categories, may be able to transfer their property tax base when selling existing property and moving anywhere in the state. That's a good thing. That doesn't really impact the investment properties, but this is a good thing to cause people to perhaps think about moving. But the second piece of Prop 19, the not so good piece, was reassessment of inherited properties. So there can be a $1 million exemption if the heirs take it as their principal residence. But everything else, all the inherited property would be reassessed to have a higher property tax, which could be significant. And so I am actually having conversations with people who have inherited property and are now thinking about having to sell just because they won't be able to afford the property taxes. Then there are also rental restrictions such as AB 1482, which passed 2 years ago and took effect last year regarding rental caps in the state, throughout the state, and then local rental restrictions being introduced every year. So there are these factors that are causing people to rethink, maybe they need to move elsewhere. And then, of course, personal and financial goals, such as just moving investment property to a different area or a different state. There are those who are thinking maybe to consolidate if you have multiple properties, to be able to sell those and exchange into a single larger one for a better cash flow, better cap rates, etc. And then others who may be thinking about actually taking a larger property and splitting that into multiple smaller investments. And this may have a little to do with estate planning, which Elsie will actually be talking about later. And then planning for retirement, dream home or otherwise for the long term. So wanting to exchange to something that you can eventually use as your dream home. So again, why the reverse exchange and the bridge loans? Why is that a favorable option for being able to do this? And it goes back to the market update, which is there's a lack of inventory throughout the nation and even abroad. And so trying to purchase a new property and sell an existing one may become a challenge in terms of both the timing and the financing. So what's nice about, we just wanted to provide these as options because for the reverse exchanges, it provides the ability for owners to look for the right replacement property first and then sell with less stress. The bridge loans will help to provide the financing for purchasing the replacement home first and then being able to make competitive offers rather than trying to figure out if you can finance two properties at the same time. This will provide a little bit of a bridge to be able to help bridge that gap in the financing and make both of these possible. These options are not necessarily the most optimal for everybody, but I think it's good to have those choices and those options available. And with that, I'm going to go ahead and hand over to Ron to be able to take over, and he'll be covering the reverse exchange and parking transactions.
Thank you very much, Jean. As Jean mentioned, my name is Ron.Ricard. I work for a company called Investment Property Exchange, or IPX 1031. I have been doing exchanges for close to 20 years now. I've spoken at Jean's meetings for almost as long as you've had your company. So I appreciate that very much. Next slide. So my goal today is not just to tell you about a reverse exchanges, because I'm sure a few of you on the call probably want to just get a refresher about what a regular 1031 exchange is, because ultimately that's what you're doing. So 1031 exchange just refers to the section of the tax code that allows you to sell investment real estate, buy replacement investment real estate, and in doing so, you get to defer paying taxes on the profit that you've made. So, what does that mean in English? You have a rental house. It's been a rental for the last 20 years. You want to sell that and buy a fourplex. So, you list the property. At the close of escrow, the money comes to a third party called the intermediary. That's a company like us. You then go out and find the fourplex, and we send the money to the title company on that side. So, you're selling investment real estate, you're buying investment real estate, and because you never touched the money in between, because we had it, you get to defer paying taxes on the profit that you made. Next slide. So the first thing to realize when it comes to exchanges is that there is a very misunderstood term, and that term is like kind. The key is any investment real estate is like kind with any other investment real estate. So you can sell a rental house and buy a shopping center. You can sell a farm and buy an apartment building. You can sell bare land and buy a rental house or a commercial building. Any kind of investment real estate is like kind with any other kind. Don't feel trapped by the term like kind. The reason that term is in there is because until very recently, we were able to do exchanges on what I would term personal property, airplanes, farm equipment. I've done exchanges on horses. I've done exchanges on Budweiser distribution routes. But that's what like kind meant. It means if you sold a boat, you had to buy a boat. If you sold a horse, you had to buy a horse. But all personal property exchanges went away in the 2017 tax rewrite. And so now 1031 exchanges is only about real estate. But again, any kind of investment real estate to any other kind of investment real estate. Next. The couple other things that you need to know in an exchange is that you do need to reinvest all of the money. It's not just the equity, not just the profit, everything. So if you sell your property for $1 million, you need to buy at least $1 million worth of replacement property. You can buy more, no problem. If you buy less, then you pay tax on the difference. That's referred to as boot. So if you sell for $1 million but only buy for 900,000, you pay tax on the difference. Similarly, and this will become important in a little bit later, all of the equity from the sale has to go as a down payment on the new property. Any cash left over, you pay tax on. So the key here is even if you're buying something more expensive, if you get too big of a loan and have cash left over, that cash will be taxable to you. Obviously, if there was a loan on the property, you need to bridge that difference somehow. Most people will get another loan to replace the loan they have, though if you have your own cash, you can use that instead. So equal or greater, use all the cash. As long as you're doing that, you are deferring all your taxes. The last important thing to know when you're doing an exchange is that there is a very strict timeline, and this will become very relevant as we talk about reverse exchanges. From the day you close escrow, you only have 45 days to identify, to tell us what you are going to buy in replacement. Now you have 180 days, about 6 months, to actually buy it, but you must buy from the list that you provided to us during the 45 days. Now, one of the things that you probably heard or understood from Gene's talk at the beginning is that there is a lack of inventory. There is not much property on the market. It's going very quickly. And I will expand on what Gene is saying. This is almost everywhere in the country. I talk to real estate agents all over the country, whether it's North Carolina, Idaho, Austin, Seattle, Miami, and they all say the same thing. We have the hottest market in the country. And I always say, no, you don't. Everywhere is the hottest market in the country right now. So that 45-day clock really is a scary proposition for a lot of people. Now, one of the things people will do sometimes to help themselves with that 45 days is to ask for longer escrows. So instead of asking for a standard 30 or 45-day escrow, sorry, standard 30-day escrow, you may want to ask for a 45-day escrow or even a 60-day escrow, something that gives you more time before the escrow closes, because once that escrow closes, these clocks start and you cannot stop them. There are no extensions, no exceptions, and no excuses. So because of this 45 days, a lot of people are afraid about doing exchanges. They are not comfortable that they'll be able to find a property within the 45 days, or sometimes they have found that property that they want to buy, and now they haven't sold theirs yet, but the seller of that property wants to close as quickly as possible. Those are some of the reasons why a lot of people look at doing reverse exchanges. Next, there we go. So the first thing to realize in a reverse exchange is that it doesn't matter when you go into contract. If you find a property that you want to buy, and the seller is willing to wait until you sell your property, that's okay. That is still a regular exchange. But if you actually need to close escrow on the one that you're purchasing first, that's called a reverse exchange. Now, the truth is, this should be called a parking transaction, because our job in a reverse exchange is to actually take title to one of the properties in our name. The first thing I will mention about reverse exchanges is, if you've already bought the other property, please don't call me, because I cannot help you. Because if you've already bought the new property, now you own both properties, and you cannot do an exchange into something you already own. So we have to be involved at least 2 weeks before you buy that new property. Next. Now, one thing to note is that 1031 itself is part of the tax code. It's been part of the tax code since 1921, so literally 100 years. But the IRS occasionally will give us rulings and procedures for certain nuances within 1031 exchanges. And in the year 2000, they actually issued the authority on doing reverse exchanges. So the way we do them is the way that follows the recipe that the IRS tells us to do them. It validates them. It tells us exactly how to create the structure, and we do so in a way that is pretty much bulletproof to the IRS. And in the thousands and thousands of reverse exchanges we've done over the years, we've never heard of one of them ever failing the IRS test, because we make sure we follow their safe harbor procedures. Now, there are 2 ways of structuring reverse exchanges. The easiest way to do them is where we take title to the property that is being purchased, referred to as the replacement property part. This is the most common way. Essentially, you come into escrow with the $1 million or whatever it is to buy that new property. Then we create something called an EAT, which is, I hate that term. It's referred to as the exchange accommodation title holder. The reality is, I just call it the LLC. So we borrow that money from you, buy the property in an LLC that we create. And so while we're entitled to the property, we lease the property to you, so you still have full control over it. But the key is, you technically haven't bought it yet, so you haven't done your exchange yet. So now, once you have sold your property, next slide, then we will just do the exchange. So here the exchange is actually then done at the end. Now that you have sold your property, you acquire the new property from us, from the EAT. So now you have you've received that property. So in other words, you sold your property, you've received this property, and now obviously you're going to get your money back from the money that you have invested. Now, the key thing about these is that, actually go back one slide, I'm not quite there yet. The key about these is that they are a little bit more difficult, and we'll talk about this a little bit later, but getting a loan on this thing is very difficult, which is why Elsie is on this phone call, because conventional lenders do not want to play ball where they're lending you the money and have our LLC be on title to the property. So this is not an exchange we can do every single time. There is, though, a second way we can structure reverse exchanges. Now, next slide. And this is where we park the relinquished property. So technically what's happening here is we are doing the exchange at the very beginning. You are selling us your property, and now you are acquiring the replacement property. Now, mind you, we do not give you any money for the sale of the property, but the exchange here technically is done first, which is why you need to come up with that money to buy that property. So you have sold us your property, you have acquired the new property, and then you need to find someone to buy the replacement property from us. In any reverse exchange transaction, we are dealing with the same timelines as a regular exchange. In other words, everything has to be done within 180 days, which is about 6 months. So whether we take title to the property you're selling or the one you're buying, the whole transaction has to be completed within that 180-day window. Next slide. Now, the key here is that once we sold the property to the buyer, and now the exchange is complete. Though again, the 1031 itself happened at the very beginning when you sold us your property and you purchased the replacement property. Next. Now, why would we park the property that you are purchasing, the replacement part? Well, it's easier. You need to come if you do need to get a loan, and now you only need to come up with a down payment equivalent to whatever the lender is going to need. And this again is where Elsie comes in, because conventional financing will not work. This is a negative, will not work for replacement parked reverse exchanges. You need to get a portfolio lender or some kind of private money lender who will lend to them. So the good news here is you typically need less of a down payment. If you have all the cash to buy it, and some of our clients do, then it's easy. If you don't, then you need to work with Elsie to figure out how much of a down payment you can. The other advantage to them is that frequently, not always, but frequently, we can avoid having to do a second escrow because the property is sold to us. And so what we do, instead of just selling the property to you and going through a second escrow, is that we actually will just give you the LLC. And by giving you the LLC, we can often avoid that second escrow and transfer tax. There are advantages to parking the relinquished property. And the main one is that you now are buying the property in your name. So getting a conventional loan is much easier because you're the one buying the property. Now, there are some cons to them. The first one is that you still need to come up with a down payment at least equivalent to what your equity is in the property you are selling. Remember earlier when I said that in an exchange, you have to use all your equity from the sale towards the purchase of the new property? Well, if you're doing it this way, you're actually doing the exchange up front. So you have to be able to you have to be able to come up with that same amount of equity that would have been coming from the sale is going to have to come from your pocket as a down payment. The other issue is you aren't sure what you're actually going to sell your property for. If you think you're going to sell your property for a certain amount of money and you're going to net X dollars as a down payment, that's great. But if you sell the property for more, then you probably have some cash left over. If you sell the property for less, then you probably put more of a down payment than you needed to. So determining the value can be a little bit difficult. Technically, the loan is due if there is a loan on the property, technically it is due when the property is transferred, but the reality is that almost never becomes an issue. The other issue is, though, that you definitely now have to go through a second escrow because you are selling the property to us and we are selling the property to the final buyer. This is not that bad if you're in an area that does not have a city transfer tax. But if you are in a place like San Francisco or the city of San Mateo or Palo Alto, or worse, Berkeley or Oakland, that has a very significant city transfer tax, the cost of that extra escrow can get very, very expensive. I had one recently where the client wanted to do a reverse exchange for a very large apartment building in Alameda County, and the transfer tax alone was going to cost him $80,000. So it's a so that second escrow can be expensive. The other thing is, if for some reason you end up not selling your property during that 180 days, at that point we will give you the property back. But now when we give you the property back, guess what? The county is going to call that a change of ownership, and they're going to reset the property tax basis. So this becomes a problem if you end up not being able to sell your property during the 6 month. Again, in today's market, I'm not too worried about that, but there are some situations where clients have done this and have not been able to sell their property within that 180-day window. One thing I do want to mention also about reverse exchanges is that they are a more expensive transaction. Whereas a regular exchange will cost you between $1,000 and $2,000, a reverse exchange is going to cost you a minimum of $6,000. And for most clients, it's going to be between $7,000 and $8,000. So let's just say for most people, $6,000 to $10,000 for a reverse exchange versus $1,000 to $2,000 for a regular exchange. So that is something that you want to factor in when you're thinking about doing this. Is that my last slide, Gene? I think it is. So anyway, that is essentially what a reverse exchange is on the mechanical level. Again, the key here is that you are always still doing an exchange. It's just that for a temporary amount of time, we as the intermediary are just parking title, and so that you are never on title to both properties at the same time. This is my contact information. You are always welcome to call me with any follow-up questions. But now the hard part is always, where do I get the money? And this is where I'm going to pass it on to Elsie, and she'll tell you all the magical places she's hiding your money.
Thank you, Ron. Before you do that, I just wanted to ask you, with all the costs and the complicated issues of doing a reverse exchange, are you seeing a lot of people still exercising this to doing this?
Absolutely, and thank you for asking that question, because I meant to say this. Right now, we are doing a record number of exchanges. Period. And you mentioned a lot of reasons. Sometimes people right now they're moving their money out of the country or out of the Bay Area, out of the state or out of the Bay Area to get better cash flow or reposition their assets for where they want to move to eventually. There are a lot of reasons why people are doing exchanges right now, but we are doing a lot of them. But just as importantly, if not more importantly, we are doing an even greater proportion of our business these days is reverse exchanges. And I think the lack of inventory, the 45 days, really is scaring a lot of people. And we have an entire division that's all they do is reverse exchanges, and we're doing well over 100 of them every single month. It's become a very, very significant part of our business. And I mean, I don't know how long this is going to last, but right now we are very, very busy. That's also why these things take at least 2 weeks to set up, because we have to create the LLC. It's just a much more involved process than a regular exchange.
Okay, thank you. And maybe we'll have time for more questions afterward, but we'll go ahead and launch hand it over to Elsie, so she can cover the first one.
So I learned something new every time I listen to Ron, and I've heard, I think, his presentation at least 4 or 5 times. And Jean, thank you for organizing this event. So my name is Elsie Wu. My company name is Abundance 99 Inc. And just like Jean, I believe in abundance. I believe in helping others to become, to achieve their goals and dreams, and together we'll all win together, however win is defined. So I am actually a licensed California real estate broker, and also a very active real estate investor. For the last 10 years, most of my business is actually in private money loans, and our funding generally comes from local Bay Area investors, not the super wealthy, not the top 1%, but people who are really good savers and who just want to diversify from the stock market. And we pull our money together to do private money loans to facilitate transactions that banks don't want to touch. And then at the same time, we Abundance also help our clients who are able to migrate from a private money loan to a conventional loan, whether that's residential or commercial, so that really our private money loan is just a bridge to where they can get good long-term inexpensive financing from the conventional lenders. And today I want to actually start with sharing with you our perspective as real estate investors. So as I mentioned, my husband and I are actually pretty big real estate investors. Right now we have, I want to say 40 units that we own together with a couple of our partners. And we have been actively investing in real estate for the last 14 years. At the peak, we have 102 units, a strip center, a shopping center, an office building. And over the years, we have gradually liquidated without doing much 1031 exchange because we had a lot of capital loss carryover. So now we have used up most of our capital loss carryover, and we're actively selling so that we selling and doing exchanges. So right now, I'm actually a client of IPX. And we have 2 exchanges underway, trading from 2 properties into 1. And then we are looking at potentially 2 to 4 more coming up this year. And so why are we selling? Why are we selling right now? So unlike a lot of other people who are supposedly moving money out of the Bay Area, we're actually bringing money back to the Bay Area. We're taking advantage of the hot sellers market to sell some of the properties that perhaps in other markets, it would have been harder to sell. So for example, inferior location or a more complex transaction. But the other reason that we're bringing the money back to California right now, despite the hot market, is when we bought the properties over the last 10 to 14 years, the economy was different, the geography was different, the politics were different. And now we want to set everything up so that we can be more ready for what changes may be coming up in the next 10 years, for the next cycle. So our level of involvement might be different, and the property type will be different. For example, we're not, whereas before we've had multifamily, now we're looking at going to single family so that we're not having to deal with rent control changes that may be coming in the next 5 to 10 years. And then we're also looking at how involved we want to be with the actual management and the type of cash flow we want to have. Before we were focused on cash flow. We were all about cash flow. That's why we bought a lot of properties out of state. Today, we're thinking about changing that strategy and be less cash flow driven, more appreciation driven because of the shortage of housing across the nation. And of course, we also want to lock in on the lower interest rate, and we want to stay ahead of the potential tax law changes. So this is the reason why we're so actively focused on changing our portfolio and doing exchanges right now. The next slide, please. So as we work with our investors and our investor base, here are some of the other reasons that we have heard why people are looking to do exchanges right now. So one reason that we hear very often is people bought properties and they kept it as investments after, for example, they bought their primary residence and then they moved out and kept the original home as a rental. So now they have 2 or 3 rental properties, but they have on their living trust, they have designated the properties to be distributed to the kids equally. Well, that's pretty hard to do it equally. That forces the kids to make some pretty tough decisions and potentially cause some hard feelings among the kids. So we have some of our clients who are looking at doing an exchange right now so that it's easier for the estate distribution to heirs down the road. And then we also have clients who are looking at making some changes so that when they distribute, the distribution will have less reliance on the potential potential limits on the step-up basis. And then yesterday, I actually met with one of our clients who attended our seminar last week, and they're actually looking at reducing the number of properties, because when they distribute it to the kids, they don't believe the kids can handle 7 properties at the same time. They're trying to actually reduce the number of properties so that it's more quality properties and easier maintenance. So those are some of the reasons that our clients are selling. And of course, people are looking at the property types that they want to hold. They don't know about retail. They don't know about commercial if everything is going to Amazon. They don't know about rent controls. And then some of our clients want to restart the capital depreciation, depreciation schedule, because they've reached their 27.5 years or the 35 years on their property type. So these are the different reasons that people are exchanging. So the challenge then is how do you get the money to facilitate a reverse exchange? So traditional banks don't want to do short-term loans. The traditional banks, they want to have longer-term residual income. So where a 1031 exchange may only last 2-3 months, 45 days, lenders are not interested in that short-term income. In fact, some lenders actually have commission clawback provisions in their loan for early payoffs. So that's one reason that it's hard to get conventional loans for these short-term financing needs. But the other reason is that when you're doing the reverse exchange, even when you're doing a forward exchange, sometimes your properties are in the name of an LLC. And if you are doing a reverse exchange, most likely you have an LLC, and banks don't want to lend to LLCs. So we're actually in that boat ourselves, my husband and I, where we're changing from a multifamily to single family, and our tax attorney has advised us to keep it in the LLC, don't touch anything, because California Franchise Tax Board apparently is cracking down on people who change their LLC to their personal names. They call it a drop and swap. So our tax attorney is telling us to keep it in the LLC, and that means that we have fewer lenders who want to lend to us on the upcoming exchange. So those are all traditional factors. Those are all factors why traditional lenders don't want to touch or lend on reverse 1031 exchange. So then another option is if you have cash, then you can certainly fund your own reverse exchange. That's not a problem. But a lot of the times people have the funds in their brokerage accounts, in stocks, in mutual funds. And if they want to use that money, they will have to pay 30% or more of capital gains taxes. And at the end of the day, they may only need that fund for 2 or 3 months, or maybe even shorter. So is it worthwhile to pay that 30% capital gains taxes just to use that money for the reverse exchange? And most of our clients are saying no. So finally, you have private money lenders like us, Abundance, who will do these exchanges. So next slide. I'm just going to go through the mechanics of this reverse 1031 exchange financing very quickly, because I want to leave more time for questions. So in a nutshell, what we will do is when you make the offer on your replacement property, you need to make the offer in the name of yourself and/or a sign, so that you can transfer the purchase contract to your LLC, to the new LLC for the exchange accommodation title holder. You need to figure out how much loan you want to borrow to complete the purchase later on. And then once you determine that, then we will do the loan. We will fund our loan to the escrow with the LLC as the owner. We will record our loan as the first deed to the LLC on the new property, and then we will record our loan as the second deed on your existing property. And then whatever you want to bring in as your own funds or down payment for your purchase will become a junior loan or second deed to the LLC. So then all the funds are in, you close escrow on the purchase, and now you have 180 days to identify the properties you want to sell and close escrow on the sale. And when you close escrow, you bring the proceed from the sale into to pay down our short-term bridge loan. And then at that time, if you want to, you can refinance to a longer term financing or whatever you need to do to keep the price of the new property, the total price of the new property to be the same as what you have to sell to do the exchange. And then if you need to, we will help you refinance to the new to a new permanent financing. So Jean, next slide. So this is just a very high level. How much can you borrow from a loan like ours? So as I mentioned, we will have a first mortgage on your new property, and we will have a second mortgage on your existing property. So we are looking at the total value of your property to determine the loan to value, and we can lend up to 75% loan to value for your exchange. So in the example you see here, we have an existing property that's $2 million with a $500,000 existing first mortgage. And then your new property is $3 million. So the total value is $5 million. And as you can see from this example here, you have to buy a property of at least $2 million to defer taxes, 100% of the taxes. And then we can lend up to 75% of that $5 million total collateral. So we can lend up to 3.75 in this example. And that means that we can potentially lend the entire amount. And we lend the entire amount, but we will subtract your existing first mortgage, $500,000, so that your new loan amount from us is 3.25, which is higher than your purchase price. So of course, you don't need to borrow that much if you have other cash that you can use to lend to the LLC for your purchase. And once you sell the existing property, then you can figure out what is the loan amount that you want to borrow. And if you have $500,000 balance from your existing property, then you need to have at least $500,000. You need to bring that loan amount into the replacement property. But I think what Ron said earlier is that you can actually use cash for that portion, so you don't have to have a loan after the exchange. So let's see. For us, a couple of other things. We don't require appraisal. We don't require inspection. We will ask for photos of your existing property, but because we don't require appraisal or inspection, you can potentially submit offers on your replacement property without financing or appraisal contingency, which will make your offer a bit more appealing to the potential sellers. And we can also close escrow more quickly than conventional lenders. Okay, so next slide. Next steps. So it is very, very important that you talk with a good CPA or a tax attorney before you start the exchange, because you really need to understand the trade-offs of doing an exchange, a reverse exchange, and the impact of the depreciation recapture if you don't do an exchange. So I'll give you my own example. Recently, one of the properties we're selling, initially I thought that we would be able to capture or lock down around $400,000 to $500,000 of loss on that property, on that rental property that we've had for 12 years. And I was actually going to skip an exchange or two this summer. And then our CPA, after talking to our CPA, we actually learned that we would have to pay, because of depreciation recapture, we would still have an income despite our perceived losses. And we would still have to pay, I think, around $70,000 of depreciation of taxes on the depreciation recapture income. So from that, we decided to actually proceed with our exchange after all. So you want to talk to a CPA or a tax attorney to figure out your strategy. And you should get a pre-approved for your desired permanent financing amount and get that permanent financing lined up so that as soon as you finish with the sale of your existing property, you can very quickly refinance. And then, of course, you want to work with a really seasoned real estate agent to identify your replacement properties and to make sure that everything is lined up perfectly to shorten the amount of time you need our private money loan for this exchange. Okay, final slide from me. I know we're sharing a lot of details about exchange and reverse 1031 exchange, and it can seem really complicated. And you may ask yourself, is this worth the hassle? And for me, I think it's absolutely worth the hassle if you have the right team and if you have the right strategy. So reverse 1031 exchange will remove the stress from your 45-day identification period. And doing the exchange, whether it's forward or exchange, you get to lock in on your hard-earned gain tax deferred. If you wait a year or two, or if you don't do the exchange, then potentially you're looking at losing out on some of those exchanges, a tax deferral and paying taxes. And do you really want to do that if you can continue to grow your asset, grow your portfolio tax deferred? And then finally, for my husband and I, it's actually been a lot of fun looking at replacing our portfolio or upgrading our portfolio and potentially upgrading our lifestyle, because we'll have different property types that may work better in the next cycle. So it's fun to have that vision, it's fun to execute, and it's fun to complete the repositioning of your portfolio if you have the right team. And I think that's a key thing, having the right team. And Jean has been very good in terms of coaching some of my clients on the property purchase and sale. And certainly IPX, where Ron works, has been very helpful with the exchanges that I have been doing, and then with the exchanges that my clients have been doing with IPX. So thank you to Jean and to Ron. Okay, so that's it, Jean. Jean, you're on mute.
Yes, I am. Thank you. I just wanted to, so thank you very much, Elsie. And it's been, I'm really excited to have met Elsie, and I've known Ron for a while, and he's done our seminars. Literally, he was one of our first speakers, and I always want to bring him back. And like Elsie said, every time I hear from him, I learn something new. So, and Elsie, I've known less of a time, but definitely I love her enthusiasm about real estate, and it's really contagious, and really happy that we're able to kind of put this together, put the seminar together.
I think Ron, we got a really good question from the last section that I want to ask Ron to answer.
Sure.
In what state will the LLC be formed?
The LLC is formed in the state in which we hold the property in most cases. For example, if you're selling your property, if we're parking the property in California, then we will create an LLC in California. Most states require the LLC to be in their state. There are a couple of exceptions, like I think Florida is one. They don't care where it is, but most states want the LLC in their state. So the good news for that is that for at least the next 2 years, the state of California has really reduced the price of creating an LLC. It used to be close to $1,000 to create an LLC. Now it's only about $100 in most cases. Now, while there's still an $800 a year maintenance if you want them, at least initially, it's a much lower price. That has really helped people, at least for the time being, if they need to create that LLC.
Ron and Elsie are great resources, and I really am so thankful that they're willing to join us for this, and to be able to speak on, again, just having another option for people as they consider their investment portfolios. Well, so thank you everybody for joining us this evening. Bye-bye.
Have a good evening.
Bye.